Hey everybody, welcome back. Well, wild day to say the least, and we have a lot to cover because we have a huge day tomorrow. Remember that we will be live pre-market for CPI before it comes out. And I just want to go through the key levels and what exactly transpired today. We're going to dig into Apple, CPI, what we need to do with CPI tomorrow, which is huge. JP Morgan mapped out a lot of the probabilities for us, and we're going to dig into that. But let's get into the key levels that we as traders need to watch tomorrow. Now we're going to just start with the basics, and we're just going to go through exactly what we've already done in previous videos. I like linking all of this together, as you are all aware, and we're just going to start with the refresher of the head and shoulders. That is right here. Just get this little arrow and then go from there. For people that ask what drawing tool I'm using, I've tried a bunch of them. This is called Screen Brush, and I'm on a Mac. So this is left, head, right, and then you can see your neckline right in here. Now, what I like about this is how clean it was, and then how you have the failures there. So we know exactly where we need to be. And we're really at that 50, 45, 50 level. Now, what I want to say about this is if we very simply just drop the line, drop the hammer from here coming across, you can also see this level up here, which is 65. As we went through in today's call, the live call that we did pre-market this morning, we have a ton of nonsense up here. So you have a ton of walls that you're going to hit and have resistance in here. I think it's important for us to have these mapped out and plan ahead before we go into the call tomorrow. So if we mark these levels off, number one, this 35 right in here, you're already having an issue. We can already see the issue we're having with 35, 45, 35 right in there. And that's going to be something that you're going to want to watch. You're going to want to watch all these individual levels and watch how they act. You're going to want to know these little pinpoints tomorrow and see where we stop at CPI. You're going to want to pay attention to what I'm going to tell you here. You're going to want to see the movement at 8:30 tomorrow morning, and you're going to want to mark it. I'm going to just pay attention. If you take nothing else from this tonight, take this. You're going to get one bar like this tomorrow. It's going to be green or it's going to be red at 8:30. When you get that bar, I'll show you again. Well, I promise I'm going to show you here. 1 second. We'll click on this again. There we go. You're going to get a bar tomorrow at 8:30. It's going to be wild because of earnings. Once you get that bar, you're going to want to mark the top of that bar, and you're going to want to mark the bottom of that bar. And you're going to want to use those as demarcation lines all day. If you take nothing else away from this video, take that. So instead of drawing 400 lines on here, what we're going to do is just suggest that you start here and looking at those levels. Now, I have my belief on what that number is going to be, and I'll get into that a little bit. Let's clean that off. But here's your demarcation line, 44.83. You do not want to break that tomorrow. If you break that tomorrow, then you're going to break that breakout, and then you're going to have pain. The real first level that you want to get through is 45.35. You have some stuff at 45.20 that's an issue, and you can kind of see how we're settling back in that range. And we're going to talk about what's breaking out here in a moment, and then we're going to get into the stocks that you should be looking at tomorrow. But really, you have to watch 45.35. If you break 44.83, get out of the way, okay? And we're going to go through the percentage chances of this happening in a couple of minutes here, but that's definitely something that we want to focus on. Now, levels are marked. We're ready to go. You might want to screenshot this for tomorrow and watch how that works out. Please remember what I walked through earlier. In regards to the Nasdaq, this really does not get any clearer on where our level is and where that level of interest has been. Now, I showed this earlier in the day, and we're going to drill into it again. And I thought that this was just absolutely fascinating because all they did was play with us yesterday, and I'm going to show you this because I think this is worth paying attention to. Let's just drill into that a little bit more and really dive into it, because this is exactly the kinds of games that are going on right now. Now, for example, every 5-minute bar, you're just riding that resistance line. We marked this off yesterday. Then they give you the big one up, they confirm it, and then they pull the flim flam, and then what? That's it. Rejection, rallies, rejection, rejection, points in the morning, and we never saw that level again. And then they just walked us down all day. Now we can get into where the 50 is, the 55, and we can talk about all that. But the bottom line is these levels are glaring. So these are levels that we're going to want to watch tomorrow. I would use that coming straight across as the first level that you're going to want to clear across. And you're going to have another one right here. We might as well use the algo level right there over everything else, because that's frankly where you reversed in here as well. So that's where you're going to have some more resistance in there. But I think you just mark all those levels off and take a look at them. Now, when we came down today, we came down hard. Obviously, Apple's something we're going to have to talk about. But if we look at these levels and we watch how this is going, they're your first line of defense down here. Now, we don't want to see these kinds of levels break, that's for sure. But you probably want to mark these off and just watch them. And people will say, well, do you want to be this close? I do. I want to see exactly how we act at some of these levels once we form that bar. And the answer is, well, why? Well, once that bar forms like on the ES and it does on the NQ, and you have these levels and you have them marked off, and remember when I said you're going to get that crazy 830 bar, and then you want to mark the high and the low of that so you have demarcation lines, you're going to want to see which one of these you respond to the most. Why do you want to see that? You want to see that so that you know where the algos are, right? If you know where the algos are, then you can play with them. Remember, they're the sharks, we're the remora, and you have to think about it that way. You can't think that you're going to change the market. Now, you definitely don't want this to start. We don't want to start seeing 450 right here in these levels. You don't want to start seeing these levels. I can't stress that enough. You do not want to start seeing these levels. And you might just want to screenshot that, and I'm going to open it up big and you can just mark it off. But that's where we're at, and you're already seeing signs. Now, before we get into one of the indexes that had a massive reversal and looks great today, we have to talk about the divergence that we saw out there today. And I think this is very important. Now, XLK today, all day today, XLK is tech. Now, XLF rallied all day except when we got around that 130 level. Around 130 on Tuesday, we stopped. Why? One of the things that we hammered home in the community was just you need to watch the bond auctions this week. The bond auction, the 10-year that took place, the bond auction, apologies, I use two different arrow systems. So when I use the ones associated with TradingView, it goes actually inverse to the other one that I like. So right around here, you start seeing the 10-year note auction. Data starts coming out, 3999 was where we were a month ago. Now we're at 4289, which is probably a little higher than you thought we'd be going into CPI. Once people started seeing that data, we started seeing financials sell down. This is the important distinction that I think we did take away from. So what we're going to do is I want to just show you what happened today, because this kind of stuff, to me, it's really important. So if we go and take a look here, we look at XLF. Now let's compare XLF to XLK. And let me show you this because I think this is staggering. This is today. Now, XLF is in blue, XLK is in orange. Look at the divergence that you had today. Look at this. This is staggering. So what we're seeing is we're seeing people in tech scared, and they're selling into this. They're like, we've had enough, we're getting out. And then what do we have? We have the financial guys saying, no, we're getting in ahead of this. And you have this little section right here, which we can see, where you came down after the auction right there. And then it's kind of crazy, right? That's even where we started falling here on tech as well. The whole market came in on that level. It's funny how that works, isn't it? When you know what to look for. So you can see that right there. Anyway, we're seeing a divergence. My money is always on the financial guys versus the tech guys. The tech guys have very weak hands where they're like, I don't want the risk. And quite frankly, I did that with some of my short-term tech holdings today where I'm like, do I really want the risk of CPI tomorrow? You know, I could come in, NVIDIA could be down 3%. I don't want that risk. So I think that's a very important distinction. But I like the way the financials moved. I like the way that tech moved here. And I think that's very important. Now, if we drill into the leading sector, and I'm going to just clean this off, we're going to go take a look at this on the weekly, and let's drop all this off and clean all that and remove all these indicators. And then we'll just start over here and then drop that into the weekly for time's sake. So one of the things we talked about on Saturday was, do we have a new leading sector? I think we're getting there. I really do. And people will say, well, you can't lead with energy. You can for a little bit. And I know the week's not over. I know it's 2 days, but this is pretty powerful, guys. And one of the names that we were talking about in the room, and I couldn't buy it until earnings, candidly, and even then, I really want to hold off because I want to see what happens with CPI, because I have a belief that energy might be weaker than we think it is. I could be wrong. I'll explain my thesis. I explained part of it yesterday as well. I don't really want to get in front of the train, but this is really hard to ignore, especially when you see this kind of reversal where they give you this bearish engulfing at the top of a chart and then they gap you up the next day. That's just mean. And then you look at how you close. I mean, it's really nasty stuff to do to people. And then you're going, well, where's the high? Well, you're looking at it, and that's something for us to really pay attention to, in my opinion. When you're starting to see things like that, go out to the weekly, reset the chart. Let me pull this down so you can see. I mean, you're going back pretty far. You're going back to the 90s. You're at all-time highs on the energy sector. You can't really ignore this anymore or pretend that you don't want to pay attention to it. I mean, it's there, it's in your face, and we're going to pay attention to it. And you're starting to see certain names like that actually move, which we'll get into in a moment. At the same time, you're watching the stocks come in, can't get over that 500, continues to implode. Failed rally at that control bar we went over on Saturday as well. XLF is trying to hold its own. It's trying to break out, and we did get above that control bar finally, but you got right to the gap fill and you stopped. We're going to need more than that. Maybe we'll get it tomorrow, but let's get into CPI. Tomorrow at 8:30, they're going to release CPI. This is going to be watched very closely, in my opinion. There's going to be a ton of volatility based upon this. First and foremost, these are estimates versus previous. So in other words, previous is here, estimate is here. And we're looking at the previous of 4.7, and then we're looking at 4.3. Now, core means no food, no energy prices. That's what it means. Now, this is where it gets interesting. They're expecting a decline year over year, but they're expecting month over month to match what was previously there before. So there's a little bit of a disconnect here, and they're saying that core is actually going to drop faster, but this month we're going to be right around the same area, which if you annualize it out makes a little bit of sense, but it's going to really fall on the used car market, and we're going to get into the different sectors of it here in a minute, or I should say industries in a moment. But what we really want to focus on first is what is everybody on the street really focused on? Well, it varies from time to time. Sometimes they really want to look at core because they've seen little nuances. Other times they're focused on month over month, or they're focused on year over year. Now, CPI month over month, this is a huge difference in here where you have 0.2 previously and 0.6. That is a massive jump. I want to just be really clear about this. We have not had anything remotely like this where we were at 0.2 and looking for 0.6, except in early 2022 where we had a discrepancy like this. This is a huge difference, and they're basing it upon energy. Now, I've given my opinion in yesterday's video on energy and back of envelope, how I look at it. I may cover that very briefly here, but we already covered it pretty extensively. So what we have to understand before we even go any further is the street right now, meaning Wall Street, investment banks, is telling their clientele to worry about this specific number tomorrow, more so than year over year. Now that's very interesting because usually they're looking at year over year, but I think what they're trying to look for is this number and say, are we in a situation here where we're expecting this to actually move faster than first anticipated? In other words, we've had this kind of downward trajectory, and after last month, we started to have this upward trajectory. And what they're trying to say is, okay, well, that might be okay if we have some of this, but if we start getting something like this, that's not going to be okay. So this is the number to focus on, and I want to be really clear about that before we go further, because I do want to show you what JP Morgan is saying as for a percentage basis, and this will tie into actually Saturday's video and some of the things we went over last Saturday. That's why I say all these videos are linked together in some form, and I try to cover the topics. So we're going to watch for this 3.6 tomorrow, and let's be really clear. If this comes in perfect and lower, and this comes in higher, well, that's not going to be okay either. But the focal point is 0.6 month over month. Now, this is focused on month over month CPI. This is what JP Morgan told their institutional client base this morning on how they see the world. And we're just going to go through it line by line here. The very first line is headline risk, month over month prints, anything above 0.7, and we're going to lose 2.5%. I agree with this statement. Anything greater, when you're going from 0.2 to 0.6, if you come out even higher, that's not going to be ideal, and it will be a bloodbath tomorrow. It will not be pretty. I do agree with this assessment. I do think that they're also right in assessing a 5% to something like that. I don't see that. But weirder things have happened with economic data coming out of the government. The real range of what's going to happen is really within this range. And you can see why. You're saying that we're either going to come in line or up or down a little bit. And that's usually what happens. But if we come in between that 5.5 and 7, so they're saying anywhere in line, which is what they're really estimating, that you're going to come in line, they're suggesting that you still lose money on the S&P tomorrow. And I want to be really clear about that. So they're saying 5.5, even though we're looking at 0.6, we're still probably going to go down. Now, that's a very interesting statement because we haven't really seen that kind of action before. 0.7, I do agree with. I do agree with possibly being in this range. But this also includes that 0.6 number. So I find that interesting that they're saying, hey, when this comes out, we're going down if we're in line. And I think that's definitely something to pay attention to. Now, what they're saying is that they have it so nailed that there's a 45% chance we're within 5 basis points. And this is somewhat confusing. And I think it warrants paying attention to it. Because the number is 0.6. And so here's 0.55. And then if we come here, we know 0.6, and they're saying 5 basis points. Well, that's 0.55. Well, in this scenario, you're saying that we're going to lose 1%. 1.5%. In this scenario where you're saying we're going to be up 25 or 75 bips or basis points. So when you start to see that, there's a little bit of, in my opinion, what we'll refer to as investment banking flim-flam, where they're trying to have their cake and eat it too. And they're saying, well, if you're at 0.55 and 0.7 in that range, then you're going to drop 1.5%. And then they're saying, well, maybe at 0.55 or, 0.65, and understand that, like plus 0.5, well, maybe we'll go up a little bit. That's a little bit of, like, in my opinion, a macro flim-flam to put that in there. But I think it warrants explaining this. And essentially what they're saying, and I think that this is really where you have to look at it from this perspective and say, okay, what JP Morgan is saying is between 0.55 and 0.7. In my opinion, this is what they're saying. That you're somewhere between down 1.5% to up 75 basis points. That's kind of how they view the world. And basically what they're saying is you're leaning this way. And I do agree with that this is a big number. I'd rather it come in pretty hard and lower, but we'll see something that big. Now, you're also seeing 20% between 0.3 and 0.45. So I do think that's something for us to look at. And then they're saying, well, if we come in there, we come in substantially lower. Now, let's just be real blunt about this. 0.3 versus 0.6 is half of the estimate. That is a huge number to be off by. And you're saying that you're only going to go up let's call it 1.5% on average. That's kind of interesting as well. I think that there should be assessed a larger probability than 2.5% than you come in around 0.3. I think it should be lower. Now, why do I say that? And we're going to get into the individual units here now, but I'm not saying there's a 30 or 40% chance of it, but I think it's greater than 2.5%. I do. And I'm going to drill into this a little bit with the actual industries. We went over crude oil yesterday, and we went over gas and why I think that it's going to be light. I don't know if it's going to be this light. Nobody knows. No one has a clue until it's out, except for the people that produce the number. But let's take a look at this industry by industry, because that's how we can actually make money off of it tomorrow. Now, this is line by line of CPI, and this will show you on a month over month or year basis on where we're at. So what I always like to look for is these discrepancies. So here you are at 0.2, they're saying 0.6. Well, that's got to come from somewhere. So we have to look at where's that number going to come from. Just like you would look at 3.2 to 3.6 and say, well, that's got to come from somewhere. Where's it going to come from? So when you look at July and August, what you look for are the discrepancies. For example, here's a huge discrepancy when you start going through it. You have July growth of energy right here, which has 7 subcategories. And you're looking at that going, okay, well, that was 0.1. Now they're saying 6. Well, that is an inordinate change. That is a huge, huge change. Then you go through this and say, okay, that's something we have to pay attention to. You're not really coming out and telling me what you're estimating for housing. Maybe that's because you have so many different sectors of it. But energy, they're saying, is going to be through the roof. Now, one of the reasons why I think we could be lower is, and I just always do this kind of back envelope where I look at crude oil futures and I look at gas futures, and they're pretty stagnant, quite frankly, right now. And I think there's something to that. We'll talk about that maybe a little bit later here, but I do think there's something to that. You have to pay attention. This is an enormous jump in the number. Absolutely enormous jump in energy in the number. And then we just kind of go through the others and we see if we find something that, kind of sticks out. Well, this is dropping a little bit, lodging, so that's not really going to affect us. And then we start coming down here and going, well, 0.3, negative 0.2. Well, used vehicle prices are dropping, so that could help us. Now, I'm just going to say this. I got this from JP Morgan. Goldman's number on used vehicles is actually lower. We should talk about used vehicles and the strike later and how that could affect the market, especially the used car market, because that's really fascinating. I think it is. But I thought that this was interesting. So they're saying that public transportation is going to go up. Well, public transportation may go up because energy prices are higher. But we really don't see much more out of line here that's really leading us one way or another if you take a look at this. So there are some discrepancies here, but where is the real discrepancy? The real discrepancy is in energy. And the more I think about this, the more we should look at those futures again. And so you can understand how I just view this. But we're way over here. I mean, what is really going to be the driver? And when we looked at that core CPI, you can go back and look at that. That was right in line month over month. So entirely here, what they're saying is, well, the issue is public transportation, but is that really the issue because it's only dropping that much, or is the real issue energy? And I think that's what we should focus on. I think we should look at the oil futures and the gas futures, and you can understand where my head is. Comment if you think this was helpful. I wanted to spend time on this so that you guys could be prepared for tomorrow, and I wanted to show you that percentage breakdown because that's an actual professional way on a professional basis of determining outcomes so that you can plan accordingly before it happens. So one of the things I like to do, and I showed this yesterday, I'm just going to walk through it very quickly, is I will go and take a look at crude oil and I will mark off the levels that are important for month per month. So I will go and take a look at the month and say there's June 30th, and then I'll go to July 30th. And I'm just looking for an understanding of what happened to crude oil in that period of time. Let's throw that up there. And so what you're doing is just measuring that off and going, okay, well, for July, we were up about 16% on crude oil, right? And what we're trying to do is overlay this on how energy prices are going to show up in CPI. Because if you can measure energy prices here, well, this is going to overlay to what's going on there. Now, I get that it's not exact. I get there's a residual to this that then comes into this, just as there's going to be a residual here that comes into here. This is why you say, or I use the phrase back of envelope, because it's not exact. But it does give me an understanding of where we're at. And I do find it somewhat accurate. Let's move that over just a bit there we go. Okay, so if we go to this area and we use the close and we come up, well, we're up about 2% on the month. Well, last month we were up 16%. So the question really is going to be how much of what transpired here is going to overlay into this energy CPI number since we're here. And the argument might be, well, you're looking at the move versus I'm looking at how much time it's spent in this range versus how much time it's spent in this range. In other words, you might look at this and say, drop a V on it and say, well, the average price here was 75, volume weighted average, versus if I go somewhere like here and drop that in, you then would say, well, the average price now is 81 versus your 78. So does that hold water? And the answer is, I think it does, because it's a percentage of what you're moving, right? I'm interested in the percentage because that's how CPI is going to go month over month. I see that argument. I understand the argument. And again, I'm saying this is back of envelope. And usually when I use this, it's a pretty good guide, candidly. Now I will use this, and then I always want to see if I'm missing something with gas futures, meaning are gas futures doing something different? Now I'll just leave this on because we went over it yesterday, and you can see gas prices moving up today as well. But one of the things that I would just look at is same exact numbers and just go, okay, well, from here over, and we just went to, we're just going to use that date. Actually, we just use the first, which is right here, right? So we'll just use that date because it looks like a bad day the next day. 17% is where you're at, okay? And then what we would do is go from, well, we'll use the same date from here over to here. Let me just drop that there for a minute, and then we'll grab this. So what we're going to see from that date over, make sure I grab this correctly, and we drop it to here. Okay, well, from that date, gas prices are down. They're not up. So I think that's really interesting to note. So if I went here and let's highlight that area, and then we're going to do the same exact thing here. I just want to be clear, again, this is just a real quick back of envelope way of looking at the world. I know this is not how they calculate CPI, but I'm not going to do all that. And then you kind of look at where you're at and say, yeah, I see what you're saying. This one's higher than this one. So maybe that's going to overlay over. I'm not really sure about that, but I get that argument. Again, I'm looking at the percentage increase because that's what CPI is measuring. I'm not looking at what the actual value is, because the actual value from here to here that doesn't really, it matters the actual value, right? And the percentage increase of the value more than the average price. I hope that makes sense. So if we look at this percentage increase and we look at what's going on here, well, there's a clear, to me, it's very clear that this is nowhere near at the same trajectory. So if we look at it from that perspective, clean this off, I think that portion, when we went through all those industries, I think that might be lower than expected. Now, we're going to have to see how that plays out, and we'll talk about which names should move the most. So now that we know where we stand, let's go over what exactly happened here and what we need to be concerned about. Number one, with Oracle, I'm a little concerned that they were so off. And who's they? The analysts. I've never seen anything like this where we've had 3 upgrades into this and they were so off on the numbers. And you literally have Ellison telling you that you're looking to be down on the name on a certain percentage of their business as people convert over to AI. The AI portion of their business was up 100% quarter over quarter. It is what it is. I expect that to continue. I do agree with a lot of these people that saying we're in the first and second inning. And I'd be real clear about what that means. That means that this is going to be extremely volatile, why this takes time. You still have people that don't believe it and think that it's all hype more than anything else, which it's not. But it's just my belief, but it doesn't mean that it's not going to be a rocky road, and we're going to get into that. But if you take a look at Oracle and that move today, these levels, these were absolutely glaring levels. And we were actually able to take advantage of this right off the open. You had the inside bars right here, and we actually shorted right in here stock as soon as we broke there. Shorted stock, shorted options. And I can't stress this part of it enough. You need to have your levels drawn before you need them. So again, if you want to take something away, so when we had that level drawn right there, we knew where the gap fill was. So we know when we get there, we're not second guessing on what to do. We're acting off of what to do. We're not waiting for some kind of, I don't really need an indicator here if I start holding that level. Right? I'm not the only one that's looking at this level. Every trader is waiting for that gap fill, especially on the professional side or institutional side. Why? Because they know that in here, they have nothing but air. Right, so they know that they really don't want to be trying to buy in there. They just want to let it fall apart, and they want to be buying at a critical level. That's what they did. Test and broke. We actually did really well here on the options. Let me see. So this is the live data. I'm just going to scroll through it real quick. You can see the timestamps over here. Let me see when we put this on. Oracle puts. Find it real quick. So this is when we bought the puts right around the 954. The 110s, shorted stock right in there left, and I put my stop out there. I want to show this just so when I say it, you can actually see the timestamps. But you can see that right around there when we were up, we trimmed a little bit. You'll see some other trades in here, but see the Oracle puts there trimming, and then we were up more, then we trimmed, and then we held the runner. And then after holding the runner, we got out of the last batch. And what we were doing today, candidly, into all this, as you can see these timestamps, we were selling into the strength, into some of our winning stocks. And we'll get into that. And we had a nice trade in Tesla as well on the long side. Now, the reason for showing you that is because I don't like the idea, and you can always comment on it. I do appreciate your comments. I don't want to get into doing specific videos just on these trades. I'd rather show you exactly what I'm looking at and then show you a timestamp on how it was done. And actually, we did the trade. So on the way down, what we're doing, okay, anyone can show you after. That's why I try to put the timestamps in there. What we're doing is we're getting out on the way down. We know where our area is. I wait. I get this little hammer, that's enough. Close the rest of it, trades up. Now, on this side, you might want to pay attention to this because this was a lot of fun, actually. If I drill into this 9, for me, and I put this in the room, and I'm not going to go back to the room for time's sake, But I want to point this out because you're seeing a lot of this kind of action. Here's support. We know why that's there. We know this is significant. So I just put an alert out there and say, hey, if you break here, it's going to get ugly. If you break that gap fill, that means that we filled all these people that are waiting for the gap fill, right? So it really doesn't matter if I overbought or oversold. If there's nobody there, it's just going to get worse. And that's exactly what it did. It got worse. And this provided another really good spot if somebody was trying to just scalp and make some money on it. But now you know that this level is significant. And you can see how we got to it, rejected, held, tested it, held, tested again at the end of the day. You're going to want to watch this level tomorrow, 109.50, especially after CPI, because it is very textbook Oracle trading. Stocks trade like the people that trade them. I always say that they have personalities. You want to watch this tomorrow because historically that move down, like this is earnings right here. Let's pop the earnings in so you can see what I'm talking about. Historically, you'll get these moves down like here on a call, and then you get a couple days of sideways action, and then it's right back up and grinding. Now, I'm not sure that that's going to happen. This is a pretty profound drop, and this is an enormous island that you have up here now. So I'm not sure that's going to happen, but you're going to want to watch this tomorrow because everyone's going to be leaning towards the fact that it's going to continue. That's not how this one trades. And they all have little different personalities to them because they trade like the people that are trading them. So we're going to want to watch that. But let's get into some of these core names and what's going on here. I think it's interesting that the Nasdaq came in the way that it did. Let's clean up my 500 levels here. And that you're at the low end on the NQ. Let's put the Qs in for a moment so you can see what I'm talking about there. And you can see the lower low right there on the Qs. And then you look at NVIDIA. Well, where's my lower low on NVIDIA? It's one of the big zooming stocks out there. Why am I not hitting lows on NVIDIA? Well, I find that fascinating as well. And that's definitely something I'm going to be watching tomorrow. So in other words, if the market moves, look for the ones that weren't down a lot. NVIDIA was down 25 basis points today, guys. 25 basis points. Nasdaq was down 1.25%. NVIDIA is down 25 basis points. Okay, it's not a dividend yielding stock with a 2 PE. So that tells you still have demand. I don't like where it is. It does not make me feel warm and fuzzy that I'm sitting there on the 55. It is what it is. I'm below here on the 50. I am fully aware of where I'm at. Why didn't it crack today? Of all days to crack, like Meta cracked, and they didn't fall apart, but they're down. I mean, even Amazon, which is just an absolute beast, forming a flag right here for us. Look at that. And you can see this, and it just looks absolutely amazing the way that some of these names are holding. But we should drill into some of these a little bit and get rid of some of these lines so you can see what to look for. I would be looking, if I wanted to play this tomorrow, I would be looking for the ones that were green today, that were in tech, that closed green or closed less than their respective index. If I look at Tesla, it looks like a shooting star closing at the low. You could gap fill and come down to this level. To me, this was a very difficult trade today, especially the action in the morning, because it kept breaking over and over again and trying to convince you that it was going to do one thing when it was doing something else. And that was the big issue. What we noticed early on in the day and caught was that you didn't really want to be using 1 minute charts because they were just playing with us. And I'll show you what I mean by that. All they were doing today on 1 minute charts was they were getting us in positions where they'd take you over, then they'd pull the rug, they'd break a level. It was not fun at all. And then you just had Wick City, especially when you got near this yesterday's closing price. Over, under, over, it was just Wick City. So the thing to do when that happens and you find yourself getting beaten up or you don't like the action, just go out to a longer time frame. And when you go out to that longer time frame, life gets a lot clearer. So no, we weren't able to pick this off. And I'm certainly not, I'm going to just show you this really quickly. I am never buying a pattern where I'm down like this and the next bar inverts like that. And I have shooting stars inverting like that. I'm never buying that. Right? I'm going to need to see confirmation. This is what happens. I got over, got the doji, flipped the doji, and this is what we made. And that was more than enough because I was able to size correctly because I could use the doji as a stop. If you're buying into this, where's your stop? You're going to use this? I mean, you're going to get slaughtered. It's too much. It's not even just making money, guys. You have to think about the risk reward of the trade. Does the trade even make sense to put on, right? Especially if you're short-term trading. If you're long-term trading and you think that, they're the next greatest thing, then maybe it doesn't matter, but something to think about. I would watch these used car companies tomorrow. This is one we did quite well with. We bought yesterday. And we scaled out and trimmed up into that push. I think you even saw that in the notes. Why do I like the car manufacturers? Two reasons, or the used car sales. If they go on strike, if UAW goes on strike, then used car prices are going to go up considerably because you're not going to have new cars. That just kind of makes sense. Also, if used cars are not down as much as we think they're going to be down tomorrow, which is a lot, then you're going to see these names rally as well. So there's two different catalysts that could happen there. I would be looking at CVNA and AN for trades tomorrow on that. And I can't stress enough, I'd be looking at what held up today and what didn't hold up today. Now, you look at names like Meta. Did that hold up? You know, it kind of did from my perspective. I did stay above that 55. I'm not really where I want to be, but I'm still above that 55. So I'm going to want to watch that. And these balance sheet companies, they are holding up. I mean, Google's been in this dollar trading range for a little bit here, so we're going to want to watch that one too. Where I would start looking, where my head is going, where I would frankly start looking is into some of these names. You know, I went over this one and we've been talking about it in the group. We're getting there. I don't know that we're ready for prime time yet. I want to see what happens with the energy prices on CPI that I just went through. But some of these energy names just look absolutely amazing. GUSH is a great way to get exposure. I think we're in at like 37 on, you know, it's like a little turnaround break here, but this has plenty of room to run. I mean, plenty of room to run through here. And it's a 3x ETF. But if energy is hitting a high and energy prices actually go up and CPI is up, well, you're going to want to look at energy names tomorrow. So you should probably set that up. The one that I really like a lot, and I was monitoring, and I talked about it in our community, but I didn't execute on it because I couldn't get in front of it. And I'll show you what I mean by that. So let me get rid of all of I'll get rid of all those lines. I can't buy this going down, going into earnings, because you just don't know how it's going to play out. Now you're at all-time highs. You have this cup and handle, and you have this beautiful breakout. Consolidate and then go higher, and I'll be all over these names. But think about it. If CPI is higher tomorrow, that's going to be because of energy. It's very, very clear. And it means that my overall thesis that it was going to be weaker is probably not going to be accurate. Based upon that, you're going to want to look at the energy names. That's it.